U.S. Economic Report, June 27, 2026. Summary of findings. The U.S. economy as of late June 2026 is characterized by a plateauing growth phase following the volatile recovery cycles of the mid-2020s. Recent data suggest a successful transition to a neutral interest rate environment, with inflation stabilizing near the Federal Reserve's 2% target. Consumer spending remains resilient, though it is increasingly bifurcated by income level. The labor market has moved from the tightness of 2024-2025 to a state of balanced equilibrium, with wage growth now closely tracking productivity gains, largely bolstered by the widespread integration of generative AI across the service and manufacturing sectors. Key economic highlights. Inflation trends, PCE price index. The Bureau of Economic Analysis, B, released the May personal consumption expenditures, PCE, report on June 26, 2026. The headline PCE price index rose 0.2% for the month, bringing the year-over-year rate to 2.3%. Core PCE remains slightly stickier at 2.5% YoY, driven primarily by persistent insurance premiums and urban housing costs, though shelter inflation has finally decelerated to pre-pandemic norms. Federal Reserve policy. In its June 17 FOMC meeting, the Federal Reserve maintained the federal funds rate at a range of 4.00% to 4.25%. The updated dot plot indicates a consensus for one more 25 basis point cut in Q4 2026, signaling the end of the restrictive policy era. Chairman Jerome Powell's recent testimony emphasized vigilance regarding the cooling labor market over concerns of an inflationary rebound. Labor market and employment. June's preliminary employment data shows a cooling trend, with non-farm payrolls averaging 145,000 over the last 3 months. The unemployment rate ticked up slightly to 4.2%, which economists view as a return to the natural rate of unemployment, rather than a signal of impending recession. GDP growth updates. The final Q1 2026 GDP reading was confirmed at 2.1% annualized growth. Real-time estimates for Q2 2026. Atlanta Fed's GDP now suggest a slight acceleration to 2.4%, supported by a surge in domestic manufacturing output and government-subsidized infrastructure projects reaching their peak construction phases. Market-moving news. Energy prices. WTI crude has stabilized at $74 per barrel, easing transport costs and contributing to the stability of the consumer price index. CPI. Tech sector productivity. A landmark Treasury report released this week suggests that AI-driven productivity gains have added an estimated 0.5% to potential GDP growth over the last 12 months, helping to offset the demographic pressures of an aging workforce. Synthesized conclusion. The U.S. economy has entered a period of low volatility normalization. The immediate risk of a hard landing has largely dissipated, replaced by a strategic focus on long-term fiscal sustainability. Near-term outlook. Monetary policy. Expect the Federal Reserve to remain on hold through the summer, ensuring inflation is fully anchored before the final planned rate cut of the year. Consumer behavior. While the excess savings of the early 2020s are exhausted, record high household net worth, driven by a steady housing market and equity gains, will likely support moderate consumption through the second half of 2026. Fiscal headwinds. Attention is shifting toward the 2027 fiscal cliff. Market participants are beginning to price in the expiration of key tax provisions, which may lead to increased capital expenditure in late 2026 as firms pull forward investments. Overall, The macro environment is favorable for steady growth, with the primary tailwind being technological productivity and the primary headwind being the high cost of servicing federal debt. Share output.